monetary policy. It's like the thermostat of the economy. Too hot? Cool it down with higher interest rates. Too cold? Turn up the heat by lowering them. But how does this balancing act impact businesses and individuals trying to access capital? Spoiler alert, it's not as simple as adjusting your home AC. Let's dive into the mechanics of monetary policy. Central banks, like the Federal Reserve in the United States, control this policy using tools like interest rates, reserve requirements, and open market operations. Think of them as the DJ of the financial party, deciding whether it's time for a slow dance or a wild rave. When the music changes, everyone, businesses, investors, and consumers, has to adjust their moves. When the central bank raises interest rates, borrowing money becomes more expensive. It's like going to your favorite coffee shop and realizing they've doubled the price of your latte. Suddenly, you think twice before indulging. Similarly, businesses are less likely to take out loans for expansion, and individuals might hold off on buying that dream home. Higher rates are meant to curb inflation, but they also tighten access to capital. On the flip side, when interest rates are lowered, it's like a Black Friday sale on borrowing. Everyone wants a piece. Businesses are more inclined to take loans for new projects, startups get more funding, and consumers might finally splurge on that new car. But here's the catch. If everyone rushes to borrow and spend, inflation can spiral out of control. It's a delicate balance, a bit like eating spicy food. Too much, and you're in trouble. Now, let's add another layer to this puzzle. Quantitative easing, QE. When central banks buy government bonds and other securities, they inject money into the economy. It's like the bank saying, "Don't worry, we've got your back." This makes borrowing cheaper and capital more accessible. But QE isn't without its downsides. Imagine giving kids unlimited candy. It boosts energy initially. But the sugar crash? Not pretty. During the COVID-19 pandemic, we saw an aggressive use of these tools. Central banks slashed interest rates and implemented large-scale QE to keep economies afloat. Access to capital became easier, and we saw a surge in investments, especially in tech and real estate. It was like everyone suddenly discovered a treasure chest of cheap money. But as inflation reared its head, central banks had to hit the brakes. Higher rates returned, and that treasure chest? It's now locked tighter than ever. On the consumer side, monetary policy impacts everything from mortgages to credit card debt. Higher rates mean more expensive home loans, making home ownership less attainable for many. And credit card interest? It can feel like paying off a never-ending treadmill. It just keeps going. Lower rates, however, can spark a buying frenzy, as we saw during the pandemic housing boom. The result? Bidding wars that made buying a house feel like competing in a reality TV show. Who's got the highest bid? Sold. But it's not all doom and gloom. Monetary policy can also lead to innovation. Companies facing high borrowing costs often look for more efficient ways to operate. It's like when you're broke and start making gourmet meals out of instant noodles. You find creative solutions. Similarly, businesses become leaner, focusing on what truly matters. Developing countries face a unique challenge. Changes in monetary policy in major economies like the US can lead to capital flight. Investors pull out funds in search of safer returns, leaving these nations scrambling. It's a bit like a party where the host announces free cake elsewhere. Everyone leaves without saying goodbye. This capital flight can lead to currency depreciation and financial instability, creating a ripple effect on global markets. Ultimately, monetary policy is a tool, not a one-size-fits-all solution. Its effects on capital access vary depending on the economy's condition, the industry in question, and the overall global landscape. It's a bit like trying to bake a perfect souffle. Everything needs to align just right, or it collapses. Thank you for joining me on this journey through the intricate world of monetary policy and its impact on capital access. If you've ever felt the sting of rising interest rates or benefited from lower ones, share your story in the comments. Let's keep the conversation going because, let's face it, we're all players in this monetary game. Don't forget to like, subscribe, and hit that notification bell so you don't miss our next deep dive into the forces shaping our world.